Stock market investors, welcome back to the channel. My name is Jason. Today I want to talk a little bit about SoFi stock, a little bit about the economy, and some stocks that I'm looking at buying over the next 6 to 12 months. All right, here we go, guys. SoFi stock closes at, 25.60 down to 25.38 after hours. I did buy another 100 shares of SoFi when it dipped under $25 today. I think anything under $25 is a buy for me in the short term. I would like to get SoFi stock in that $20 range, but I have been nibbling small chunks of the stock in that $23 to $25 range over the last couple of weeks. It's been quite the tear, guys. Over the last month, we're up 18%. Over the last 6 months, up over 90%. Year to date, up 81%. But we're starting to get up there a little bit. PE ratio in the 50s, right? All the metrics are a little high for SoFi stock. If we go over to Yahoo Finance and check out all these statistics and the fundamentals of the stock right now, we could see back in June of 2024, we were at a $7 billion market cap. We're up over 30 now. So we've had quite the run up. Forward PE at 42. Pretty expensive, right? PEG ratio at 2.2, price to sales at 9. Back in June of 2024, it was under 3, right? Price to book was at 1.2. Price to book now is at 4, almost a 3x from that point. So I'm not in a huge hurry to be buying SoFi stock at $25 or greater, right? I'm going to kind of let this thing play out over time because we've also added a lot of debt to this balance sheet, right? Total cash $2 billion, total debt up over $4 billion now. But one thing I like to see, that short percent of the float is under 9%, right? So I want to take a look at my watch list right now over in Charles Schwab. And as we can see, VTI and VOO. VTI is Vanguard's total stock market ETF, and VOO is Vanguard's S&P 500 ETF. And as you can see, we look at this 52-week range right here. Both of them right around 52-week highs. So I'm not in a position where I want to be buying the overall market at 52-week highs, right? I do believe in dollar cost averaging, but you got to do it slowly because right now we could see VTI and VOO both right around 52-week highs. So we have to be careful buying into these indexes right now because we're pretty extended right now, in my opinion. PE ratios are creeping up near really, really high compared to the last 20 years, right? So we have to take that into consideration. So what am I doing right now? I really like adding some ETFs that are income ETFs like JEPI. That's JP Morgan's Equity Premium Income Fund. The dividend is coming in around 8% right now based on this $56 stock price. And with ETFs like JEPI, you really want to go to the historical data tab and you want to see how this dividend's playing out. So I always like to go to max. And then once this kicks up, we're going to go to monthly. And we can see, because this is a monthly dividend player, and it's going to let us know all the dividends that have paid out, right? So you go to dividend only, and we could see how much it pays out per share, right? And we could see there has been a decrease over the last few months in the amount that they're paying out per share, right? But if you look at the historical averages, it's pretty much over the last few years, it goes up, it goes down. There's ebbs and flows to this thing, but over the last 12 months, you're going to get around 7 to 8% on your money, paying anywhere from 29 cents up to 60 cents per share that you own each and every month, right? And the way you calculate how much you're getting over a year, you take the 35 cents, right? You times that by 12. You take our little trusty calculator, 0.358, times that by 12, and we get $4.29. We divide that by the current stock price, 56.78. And, we see 7.5%. So I like that considering how much the market is kind of extended right now. And now I want to talk about some stocks that I am looking at and they look pretty juicy. UPS is really interesting to me, guys. It's paying over a 7% dividend right now. It's right now at like 52-week lows, trading in that $83 range. That's where the 52-week low is, $83. It's trading at $85. So right around the 52-week low. Target is interesting to me as well. And so is Whirlpool, right? Especially with interest rates going down. We could see a boom in the housing market that could be really, really interesting for us, right? If we take a look at Target's stock, if we do a discounted cash flow model, simply Wall Street put this together for us. It's saying it's 40% undervalued. The dividend's creeping up around 5%, right? The fair value they estimate at around $155. $93 is the current stock price. But man, Target stock has been an absolute dog. Year to date, down 30%. Yikes. Over the last year, down 39%. And over the last 5 years, from peak to trough, where we're at right now, down over 64%, right? So we might want to pump the brakes on Target stock until we see a reversal in the trend. I'd rather buy it at $100 per share and then buy it now at 90 and see the stock go down to 70. But if I am going to add Target, I'm going to add it very slowly, right? Dollar cost average into it. But another stock I really like I was mentioning before, is Whirlpool stock. Dividend yield creeping up around 4%. This is another stock that ever since we've seen high interest rates, really high interest rates, this stock has suffered, right? Pretty much on par. It peaked in 2021, and then interest rates have been extended for the last 4 years, right? And we're down 62%. So a turnaround could be in play for Whirlpool stock, right? So if we take a look at the trailing PE at 10, forward PE at 15, price to sales at 0.33, that's under 1, price to book at 2, enterprise values over $12 billion, market cap is at 5 right now. I always like to see when I'm looking at value plays if the enterprise value is significantly larger than the market cap, right? If we take a look here, guys, at the total cash, $1 billion, total debt around $8 billion, so that's not great. Levered free cash flow coming in around $600 million. So we do got to keep our eye on this debt load and make sure they don't get overextended, right? And guys, if we look at the trading information, 52-week high coming in at 135, 52-week low at 70. It's trading in the 90s right now. So there could be some value there if you're in this for the long term. The discounted cash flow model, fair value, $144 a share. Current price, $94. I'm looking to start adding Whirlpool stock under $90 per share. I think there's some value there under $90. Risk to reward, I like that, right? And then last but not least, I want to talk about UPS. I don't think UPS is in a position to go out of business. I mean, there's only 3 major carriers, right? There's FedEx, UPS, and USPS. And I think UPS and FedEx are a little more reliable than the United States Postal Service, right? They're trading at 46% below the estimated value. Earnings are forecasted to grow around 7% per year. For a big company like that, I like that. I like those numbers. The dividend over 7% is great too. But is this dividend reliable? That's one thing we have to take a look at before we start. All right, guys, you always want to click on max, then you want to go to historical data, go to dividend only, then go to monthly, right? And then we could see what they're paying out in dividends and what they've been paying out in dividends over the years. And if you take a look, man, all the way from 2005, we just see an increase in dividend payouts every single quarter. Extremely, extremely reliable, man. And even during COVID, they were still paying out their dividend, guys. We see the big jump up from 21 to 22. Really good stuff here, guys. So the dividend, in my opinion, is not going anywhere at all. We can click on statistics and take a look at the dividend payout. That's something we always want to keep our eye on as we buy dividend players, right? Payout ratio is pretty high right now, I'm not going to lie, at 97%. Really, really, really high. But the levered free cash flow over the last 12 months is $4 billion. I really like that. big debt load, 28 billion to cash 7 billion. But with this 4 billion in free cash flow, they're going to be able to pay off that debt for sure, in my opinion. But we want to keep our eye on the dividend payout ratio. They're probably not going to increase the dividend payouts anytime soon, in my opinion. But I do think at 7%, there's some share appreciation in there for us, as well as a reliable dividend, right? So I think that's a great play over the long term. When we're looking at stocks in this particular market, man, I don't want to be buying stocks near their 52-week highs, man. Like the Bitcoin one that I'm looking at, it's kind of high. Cheesecake Factory is a little high as well. All of these stocks that are like near their 52-week highs, I'm not really in play for. Like Stone is on my watch list. It's right at 52-week highs. VTI, VOO, both near 52-week highs. I kind of want to avoid those type of companies in an overextended market in case there is a downtrend in the stock market. And right now, the economy is looking a little bit shaky, right? The labor market deterioration, just 22,000 jobs were added in August. That's dramatically lower than what economists were expecting, 76,000. So Trump's tariff economy is not looking great right now. Negative job growth for the first time in nearly 4 years. The U.S. economy lost jobs with a decline of 13,000 positions in June, something we have to keep an eye on, a close eye on, as we move forward with our investments. The rising unemployment is scary as well. It jumped to 4.3%. 5% is the danger zone, guys. Once we approach over 4.8% and get towards 5%, that's when the economy can really turn sour. Right? So if we keep approaching that number, guys, you got to really be careful with your investments. Start getting cash heavy. That's kind of what I'm doing right now. And the data underscores the extent to which consumers and businesses are struggling to accommodate the weight of tariff, stubborn inflation, the decline in America's crucial immigrant workforce, and overall economic uncertainty. So an immigrant workforce is cheap labor, right? And when we don't have cheap labor, prices are going to go up for everything, man. Everything that has to do with building of houses, with farming, with food. We're going to see an increase in inflation, and that's going to hurt each and every one of us, guys. The economy is a little scary right now. I'm not going to lie. So I wanted to let you guys let you know what I'm doing in this market straight up. I'm starting to get a little bit cash heavy. I have over $30,000 in cash on the sidelines right now. That's over 10% of my overall kind of net worth in the stock market. And I think I'm going to get more and more cash heavy as these numbers deteriorate. If the labor market continues to deteriorate and unemployment continues to increase, I'm going to start scaling out of a lot of my investments, build up some cash, sell some puts so I can get stocks at cheaper prices. If you want more updates on the economy and the stock market, make sure you hit that like button and subscribe to the channel. We'll catch you guys on the next video. Thanks for tuning in. Peace.